I observe something developing in Federal Reserve monetary policy that represents the most dangerous compound risk to patient capital I have calculated in 7 decades of systematic investment analysis. The interest rate trap the Fed has constructed through 14 years of emergency monetary accommodation now threatens to destroy more accumulated wealth than any market crash, banking crisis, or economic recession in modern American history. And the institutional decay this creates will compound exponentially as demographic pressures force liquidation of assets at precisely the moment when buyers disappear from the market. What concerns me most profoundly is not the immediate political theater surrounding Fed policy announcements, but the mathematical certainty that current interest rate structures have created systematic imbalances that cannot be resolved through conventional monetary tools without triggering cascade effects across every major asset class that supports retirement security for millions of Americans who have no alternative sources of income or wealth preservation during the demographic transition we are entering. The Fed's balance sheet expansion from $800 billion to over $8 trillion represents more than aggressive monetary stimulus. It represents the systematic destruction of price discovery mechanisms that enable capital markets to allocate resources efficiently toward productive economic activity rather than speculative asset inflation that creates the illusion of wealth while undermining the foundational structures that support long-term value creation and preservation. I have spent my career studying how compound interest rewards patience and punishes leverage, but the current interest rate environment has inverted these traditional relationships in ways that threaten the basic mathematics of wealth accumulation that have functioned consistently since the establishment of modern capital markets. When overnight lending rates remain near zero, while inflation compounds at rates that destroy purchasing power faster than traditional safe assets can preserve principal, the fundamental assumptions underlying retirement planning and institutional investment become systematically unreliable. The commercial real estate crisis emerging across American metropolitan areas represents the most visible manifestation of this interest rate trap, but its implications extend far beyond immediate property valuations toward the systematic destruction of regional banking institutions that form the backbone of commercial lending throughout the American economy. When office buildings purchased with cheap debt during the accommodation period face refinancing requirements at current market rates while tenant demand has permanently declined due to remote work adoption, the mathematical outcome is predetermined: systematic defaults that will cascade through bank balance sheets with precision that defies political intervention. Regional banks holding commercial real estate portfolios concentrated in office properties, retail centers, and hospitality assets face a systematic repricing of their loan books that cannot be resolved through extended workout periods or forbearance programs because the underlying cash flows have permanently deteriorated while debt service requirements have increased exponentially. This creates systematic insolvency that spreads through community banking networks faster than regulatory interventions can contain the damage to depositor confidence and credit availability. The interest rate sensitivity embedded in pension fund portfolios represents perhaps the most catastrophic dimension of this compound risk because the demographic mathematics require these institutions to generate consistent returns from bond portfolios that have become mathematically incapable of supporting promised benefit payments when interest rates eventually normalize. State and municipal pension systems across the United States face funding ratios that assume investment returns impossible to achieve with current bond yields, while beneficiary populations expand faster than contributing workforces can support through tax revenue. This demographic and mathematical collision creates systematic pressure for pension administrators to increase allocation toward riskier assets at precisely the moment when those assets have become overvalued due to the same interest rate distortions that make traditional fixed income investments inadequate for meeting actuarial assumptions. The resulting systematic risk concentration in equity markets, real estate investment trusts, and alternative investments creates correlation effects that eliminate diversification benefits when market stress eventually forces simultaneous liquidation across multiple asset classes. Insurance company balance sheets face identical mathematical pressures because their liability structures require them to match long-term obligations with investment returns from portfolios increasingly dominated by assets that cannot generate adequate yields without accepting credit risks that violate fundamental principles of insurance mathematics. Life insurance companies, annuity providers, and property casualty insurers have been forced into systematic risk-taking that undermines their capacity to honor policy commitments when economic stress requires simultaneous claim payments while asset values decline. The systematic nature of this interest rate trap extends beyond individual institutional failures toward the complete breakdown of retirement security for American workers who have accumulated wealth through employer-sponsored defined contribution plans that assume continued appreciation of financial assets during their withdrawal phases. When demographic mathematics require systematic liquidation of retirement accounts by aging baby boomers, while younger generations lack sufficient income and job security to purchase those assets at current valuations, the mathematical outcome approaches systematic wealth destruction for an entire generation. Federal Reserve officials acknowledge these systematic risks through carefully coded language and policy statements, but their public communications systematically understate the mathematical impossibility of resolving these imbalances without triggering deflationary asset repricing that destroys accumulated wealth faster than monetary accommodation can restore confidence. The Fed's policy tools work effectively during economic expansion when credit demand supports money creation, but they become systematically ineffective when demographic contraction reduces organic credit demand, while existing debt burdens require service payments that exceed current income generation. The international dimension of this interest rate trap compounds these systematic risks because global capital markets have become dependent on dollar liquidity creation that supports asset valuations worldwide. But the demographic and fiscal constraints facing the United States make continued accommodation increasingly incompatible with maintaining dollar purchasing power and international confidence in American monetary policy effectiveness. Foreign central banks face identical demographic pressures while maintaining even lower interest rates and higher debt to GDP ratios, creating systematic vulnerability to capital flight when confidence in coordinated monetary accommodation eventually fails. I calculate the resolution timeline for these systematic imbalances through demographic mathematics rather than economic forecasting because the underlying pressures are actuarial rather than cyclical. The baby boom generation will require systematic liquidation of financial assets to support consumption during retirement years, regardless of monetary policy accommodation, while successor generations face housing costs, education debt, and family formation expenses that prevent them from accumulating sufficient capital to purchase those assets at prices that preserve boomer wealth. The commercial real estate crisis represents the leading edge of this systematic repricing because office space demand has declined permanently while debt service requirements have increased dramatically, creating mathematical certainty of default rates that will cascade through regional banking systems with predictable timing. Shopping centers, hotels, and retail properties face similar mathematical pressures as consumer spending patterns shift permanently toward e-commerce and service sectors that require less physical infrastructure. Bank regulatory responses to commercial real estate stress have focused on extending loan terms and reducing current payment requirements, but these accommodation measures simply delay recognition of losses that compound with mathematical certainty as interest rate increases make refinancing impossible while property cash flows continue deteriorating. Regional banks with concentrated commercial real estate exposure face systematic insolvency that regulatory forbearance can postpone but cannot prevent because the underlying mathematics of debt service versus rental income have become unsustainable. The systematic nature of pension fund vulnerability extends beyond public sector systems toward corporate-defined benefit plans that remain mathematically underfunded despite equity market appreciation because their liability present value calculations use discount rates tied to treasury yields that have made benefit promises impossible to fund with safe assets. Corporate pension sponsors face systematic pressure to increase employer contributions at precisely the moment when business cash flows are declining due to higher interest expense and reduced consumer demand from demographic spending contraction. Insurance industry, systematic risk concentration in asset classes affected by interest rate normalization creates correlation effects that eliminate traditional diversification benefits when market stress forces simultaneous liquidation across multiple sectors. Life insurance companies have increased allocation toward commercial mortgages, corporate credit, and alternative investments to generate yields adequate for supporting policy liabilities. But these concentrations create systematic vulnerability when credit stress affects multiple asset classes simultaneously. The mathematical precision with which demographic transition will force asset liquidation by retiring boomers, while younger generations lack purchasing power to maintain current valuations, represents systematic wealth destruction that monetary policy cannot prevent because the underlying constraint is demographic rather than financial. Federal Reserve accommodation can delay asset repricing through liquidity creation, but it cannot resolve the fundamental mathematical imbalance between required selling by aging populations and available purchasing power from successor generations. International capital flight from dollar-denominated assets represents an accelerating systematic risk as foreign investors recognize that American demographic and fiscal mathematics make continued monetary accommodation incompatible with maintaining purchasing power and international competitiveness. Foreign central banks face identical demographic pressures while maintaining even lower interest rates and higher debt ratios, creating systematic pressure toward alternative reserve assets and regional monetary arrangements that reduce dependence on dollar liquidity creation. The compound effects of systematic deleveraging across commercial real estate, regional banking, pension systems, insurance companies, and international capital markets create mathematical certainty of wealth destruction that patient capital must position to survive, rather than attempting to preserve current valuations through continued exposure to systematically overvalued assets. The interest rate trap the Federal Reserve has constructed makes traditional defensive positioning through bond portfolios mathematically inadequate because normalized interest rates will destroy principal values while current yields fail to preserve purchasing power against inflation. Markets reward mathematical reality and punish systematic denial with precision that compounds over time. The demographic transition and interest rate normalization represent systematic forces that will resolve regardless of political preference or monetary policy intervention. Patient capital must position for systematic asset repricing while maintaining purchasing power through assets that provide protection against both deflation and currency debasement during the institutional restructuring this resolution will require.